Hey everyone, Rob B here with Rob D, and you are listening to the Property Podcast. Now, we love an opinion on property and the future and making predictions. And you know what? Sometimes we've been right and sometimes we've been wrong. But we tend to go against the crowd. And this week, we've got a real expert who absolutely did go against the crowd with his prediction about inflation and was absolutely spot on.
Hello, welcome to the Property Podcast. Rob D here with Rob B, and this is an episode I'm so excited about. We spend our time advising a multi-million-pound property fund, which you can find out more about at portfolio.co.uk. And we've put together hundreds of transactions over the years. And this is the show where we take some time out to bring you the knowledge that we gain along the way for free. So today you're going to hear a great conversation about, seriously, one of my favourite subjects, inflation. And I'm sure you'll want to stick around anyway, but do stick around to the end for Hub Extra, where we've got a couple of wonderful YouTube recommendations to take your learning further.
So it was a mini budget yesterday, and with so much going on in the world right now, you may have missed that. Well, we haven't, although we're not going to talk about it right now because we recorded this a few days before the budget. But we will cover it in our market update, which is just a couple of weeks away now. That's going to be a bumper episode because we'll be looking at inflation based off the conversation you're about to hear in this podcast. And we'll definitely, Rob, be talking more about this story that we are going to cover, which is that interest rates have risen again. But this kind of caught me off guard because they've only just gone up. And in fact, they've gone up for the third time in 4 months. I don't know about you, but I was slightly surprised by this. I did expect them to carry on going up this year, but not as quick as it's happened. Maybe that's just me, but I was a little bit surprised. This came out of the blue.
Yeah, interest rates have reached their highest level since March 2020, which is actually kind of puts it in perspective a little bit. But they have risen to 0.75%. The biggest impact of this is it makes me feel a bit nervous about my prediction around interest rates for this year, which was that they wouldn't go beyond 1%. There's quite a lot of year left, and the Bank of England finally seemed to have got into rate hike mode. So I'm a little bit nervous, but I agree with you, Rob, even though obviously with inflation, which is now approaching 8%, you would think that they should actually be doing far more than this if they really wanted to get a grip with it. I'm still surprised that they've actually done it, perhaps because we've had so many years of them bottling these decisions. But what will they do in future? What does this all mean for your mortgage and for property prices and everything else? There's a big discussion about that to be had in Market Update in a couple of weeks' time.
And before we kick off with the interview that we have today, just a quick note to say thank you to everyone who's been really supportive of Portfolio and the announcement we made last week that the minimum investment amount has dropped from 10,000, we've halved it, to 5,000. So we're really excited about that, and we're really happy that we've been able to do that because it's going to allow more people to access the app. And also, a lot of people seem to be interested because they've signed up to our waiting list, which is on our website. You can't access the app by just downloading it at the moment. You have to go via the waiting list just so we can keep control of the quality and make sure we service everyone at the levels that we want to. But if you want to find out more about Portfolio, what it is, how it works, then go to portfolio.co.uk. So, Rob, you've gone and set this interview up, and I'm so glad you have. But I just love the way it's all happened because we're fans of YouTube. But if you were to see what's recommended to us on YouTube, probably most people would call us boring, dull. We tend to get served stuff about economics, or in my case, chess, and a few other little bits that most people probably wouldn't want to watch. But that's why we love YouTube, because it's so smart and seems to give us the type of content that we love, and it just improves the more you use it over time, which you could say is a little scary, but in this case it's absolutely paid off because you've come across a YouTube channel that has got a modest following, but not one of the biggest players out there. But you've found someone who's been talking about a subject we like to talk about, inflation. And by the sounds of it, he's really impressed you. Well, so much so that you've invited him onto the show.
Well, that's the wonderful thing about having the podcast, because we're talking about our guest today, Tim Congdon. I found his channel for the Institute of International Monetary Research. YouTube served me up a video. The view count was not the thousands, but the hundreds. And yet, watching it, I couldn't believe what I was seeing. I was like, this is incredible. This is a type of analysis that I haven't heard anywhere before. It's completely different from anything that you see in the mainstream media. I would love to talk to this guy and ask him some questions. Oh, luckily I've got a podcast, so I can do that. So I sent him an email, and very graciously, Tim Congdon agreed to come and have a chat. He spent over 30 years advising governments and businesses. He's now in academia, and he frequently writes for various publications. And what I find super interesting is that he approaches economics through a framework that's not new. It's not something that he's come up with. It's something that's actually quite traditional. But because it's currently unfashionable, it's something that you just don't hear about. And as a result of approaching the world through this framework, he's ended up being very, very right about inflation at a time when everyone else has been very, very wrong about inflation. So you'll definitely want to keep on listening to hear how he came to that conclusion. And of course, as he's been right, what he thinks is going to come next. And the only place I could start out this conversation was by asking him about that brave call that he made. To start with and kind of give a bit of context to this conversation, a reason why I was so excited to talk to you is that you've been right about inflation at a time when I'd say almost everyone else has been wrong to varying degrees. And you wrote something in the International Economy, winter 2021, in which you said, in short, inflation is likely in coming quarters to be embarrassingly higher than internationally renowned economists projected as recently as last spring. I think you were spot on, weren't you?
I was spot on, and I'm sorry that sounds bombastic, but it's true. It's also important because I represent a certain approach to economic analysis, not currently very fashionable. I'm afraid it's the correct approach to macroeconomic analysis. And I may also just say this is not the first time that I've made on the face of it, rather outlandish inflation forecasts and been right. Most of those calls have been for the UK, rather than the current one is particularly about the United States, where what's going on is, in my view, is fantastic.
Could you explain in very simple terms like what monetarism is and what the quantity theory of money is?
Let's just think about a small investor. They've got some wealth. The question is, how much of that wealth do they have in the bank? And how much do they invest in, say, housing, stocks and shares, whatever? The truth is that cash is a lousy investment in the long run. So most investors want to have most of their assets in stocks and shares or houses or whatever. And so every investor has to make a decision about the proportion of cash to total assets. And the heart of my work is to say that the desired ratio of cash to total assets is relatively stable for the economy as a whole. Some people, I'm afraid, haven't got much by way of assets. And what they're thinking about is how much cash they should have relative to their income and expenditure. But again, I'm suggesting that the desired ratio of money to income and expenditure is fairly stable for the whole economy. What that means is that if the quantity of money jumps up or down, certainly jumps up and down by large amounts, then there's been a shock. And if, say, the quantity of money jumps by 50% in a relatively short period, then the desired level, the level at which people are stable and happy of their wealth and income also has to rise by 50%. Of course, processes by which that occurs are quite complex, but if the desired ratios of money to wealth and money to income are fairly stable, and they are, I can tell you they are, from a lot of evidence and so on from around the world and over time, then there is the analysis of what's happened to quantity of money is very important.
How does the quantity of money change? Because I think the whole notion of most people won't have even thought really about how much money there is. Think about how much money they have, but not how much money there is in general, or the notion of money being created. So how does that happen?
Most money is bank deposits. Most payments are made against bank deposits. So the amount of money in the economy depends on what's going on in the banking system. Deposit liabilities of the banks, the money that they owe us, depends on the assets that banks have. Balance sheets, but the two sides of the balance sheets are the same. The banks, they can create money out of thin air. This comes as a shock to people, but they can. What they do is suppose I want an overdraft of, say, £50,000 or something. I go to my bank, and one fine day, the bank manager adds £50,000 on one side of the balance sheet the asset side, that's the loan to me, and £50,000 on the deposit side of the balance sheet, which is the money I can spend when I. So what I do when I take out my overdrafts, I spend that £50,000 of deposits, which goes to other people, other companies, and so on. It goes round and round and round. So the growth of bank balance sheets depends on the growth of bank assets. The growth of money depends on the growth of bank assets. And much of the time, this occurs through new lending to the private sector. For example, let's think about the boom of the early 1970s. It's a huge increase in bank lending after a freeing up of the banking system. There's then a matching growth of deposits, which are money. There was then an associated property boom. Same sort of thing in the late 1980s. Now, having said that, it's possible for the central bank and the government also to borrow from the banking system. So, for example, there's no new lending to property companies, to individuals to buy houses or whatever, but new money balances are created. And then they do affect, the new money balances affect the property market just as much. See, what we've had in the last couple of years, the 2 years of COVID, is these large asset purchases by the central banks. What happens puzzles many people. What happens is that the central bank, just like me taking out an overdraft, goes to the commercial banks and says, look, we want to boost the economy, we want to create some money. So will you, the commercial banks, lend us some money? We'll credit your cash reserves with us, but we, the central banks, then want to deposit. Central banks get their deposit. Central banks immediately spend that on, say, government securities held by insurance companies and pension funds. The money held by the insurance companies and pension funds goes up. Suppose they've then got too much cash relative to assets. They're all buyers of assets. Asset prices rise. And really what's happened in America, Britain, Western Europe, particularly in the last couple of years, is exactly that process. There hasn't been much lending to the property sector as such, but there's been a very big increase in the amount of money, and that has affected the property sector.
That's really interesting. So the creator of money is the banking system, but that can occur naturally through a boom, banks wanting to lend, people wanting to borrow, everyone sort of getting a bit carried away. But it could also be created via a separate borrower, effectively being the central bank, because they want the money supply to increase.
Obviously the extreme case is where the government has a large budget deficit and it decides to finance that from the banking system. And then you get, in the extreme cases, Latin American type inflation rates.
Asset price inflation is what listeners of this podcast will be particularly interested in, but how does this affect CPI, consumer inflation? Because that seems to be a little bit different.
The economy is all interlinked. So let's think about, say, house prices rise by 25%. Now, look, I know that a large part of the cost is land, but let's just take it that the land price doesn't change very much. Then obviously a house builder, if wages haven't changed in price, if raw materials haven't changed in price, profit margin has shot up, okay? So the price of houses has risen by 25%. It's very profitable to build houses. So the house builders then start bidding for labor, all right? Wages start to rise. Or there's a boom in houses, so they can pay more for raw materials. So the price of bricks goes up. There's a constant arbitrage between assets. Houses is a simple and clear example, and goods and services in general that go into the retail price index. It may seem strange to say that, but in the long run, there is arbitrage of this sort. So the economy is totally interlinked. You can't separate the asset markets from the markets in labor or the markets in goods and services.
That's really interesting, because I think the way it's often talked about is they are talked about as if they're separate things. You hear a lot about consumer prices and reasons why supply chains might have been affected, so there's less being produced, or wages might be going up, so there's more demand. And then asset prices get talked about either not at all or in complete separation. But if I'm understanding correctly, it seems to be the case that if money is created, that money ends up going into assets, and it's the increasing asset values that end up having an influence on consumer prices. I know that's a massive paraphrase, but is that roughly correct?
And that's quite a good paraphrase summary of my work, because that's really the kind of thing I've emphasized in my research over the last 30 or 40 years.
So we mentioned earlier that it's the banks that ultimately create the money, but that demand for money can either come from individuals and companies, or it can come from central banks, governments. It seems like, if we're thinking about what's happened in the last couple of years, in COVID in particular, a lot of that demand has come from governments or central banks. Something that you've written recently was the key argument is that monetary financing of large budget deficits combined with central bank asset purchases resulted in unusually fast monetary growth. The United States, which you mentioned earlier, was egregious in this respect. In April, the increase in 1 month was in fact larger than in any previous full year.
2020, yes, that's right, yeah.
Yeah. So we've kind of touched on this a little bit, but could you sort of maybe make more explicit what did happen, particularly in America, but kind of everywhere, as a result of actions in response to COVID?
Okay, well, let's just talk about the United States, because this is a very interesting example. If you go back 30, 40 years, the Federal Reserve was very concerned about monetary growth, and indeed reducing monetary growth was basic to the anti-inflation task of the Federal Reserve at that time. But things have moved on, and many economists, including economists at the Federal Reserve, had forgotten about money. They knew that the central bank asset purchases would boost the economy, and they didn't know how to calibrate what they were doing. So they decided to do it on a massive scale.
What are central bank asset purchases, just to make sure everyone's clear about what that means?
The central bank goes to the commercial banks and says, look, commercial banks, the central bank just create cash out of thin air, all right? So it goes to the commercial bank and says, here's some cash, you can add that to your assets, and then you must give us a deposit, all right? And then the central bank uses that deposit to buy things, in the sort of simplest case, from non-banks, okay? You and me, buys things from us and increases our bank deposits. Now, it does this on a big enough scale, all those bank deposits in the economy, the quantity of money for the whole economy, will rise. In April 2020, these operations were so large in the USA, they increased the quantity of money by over 7% in 1 month. Now, can I just also say on this front that households tend to keep their money balances relatively stable relative to their expenditure. Holdings of money by households are much larger than by financial institutions. So, quantity of money jumps by 7%. We've all got too much money. What do you do with it? We put it into mutual funds in the US case. We put it into insurance policies. You put it into into unit trusts or whatever. And then all these fund managers, including, may I say, some of the private equity people, some of the commercial property funds, real estate investment trusts, and so on, they've all got too much money. What happens to asset prices? There have been gains in commercial property prices and housing markets big gains since May 2020. But I don't deny that things like, say retail property has still suffering a bit. But these are, and obviously COVID has been very bad for retail property, but these are sort of market forces separate from what's happening to money as a whole relative to the economy.
So you were saying that they were doing this in an uncalibrated way.
I'm going to be very open about this. The people in the Fed didn't understand what they were doing. We can look at what these economists were saying at the time of the great financial crisis, when they actually started doing this kind of stuff. And they didn't see it in the way I see it, working through the quantity of money. They saw it as working through bond yields or credit spreads, things like that. They simply hadn't thought about how to relate their operations to the quantity of money. And this has led, in the US case, and a little bit to some extent, well, also in a major way, actually, in the UK and Europe, to far too much money being created. And so our societies now have an inflation problem.
And how does that differ from what happened around the time of the financial crisis of 2008? Because my understanding, perhaps wrong, is that a lot of money was also created back then, but we didn't see lots of inflation.
What happened then was, it's very important to get the sequence of events right. We had trouble in the banking system really from August 2007. And the internet market closed and some banks were in trouble, like Northern Rock and so on. You then had an intensification of that in September 2008. And the government's central banks regulators responded by asking for banks, were demanding that banks hold much more capital relative to their risk assets. Roughly speaking, that change in the bank's capital regime was that they had to hold about 2/3 more capital relative to per unit of risk assets. This was a catastrophically stupid thing to do. And I've said that in various places and not been much noticed, but it's a stupid thing to do. Because how are banks going to react to that sort of new demand from officialdom? They're going to shrink their risk assets. They won't renew their loans. They'll ask people to repay overdrafts, etc. What is the effect of that? That is to reduce the quantity of money. At this very bad point in a recession, the banks were told to shrink their businesses, to destroy money. And that's what they did. They had to do it. They were obliged to do it, effectively by law. What happened to the economies? Of course, the recessions got worse. And so what I advocated in late 2008, early 2009, was that this other process of money creation by the state, had to be used, and used effectively in a kind of nuclear way. I advocated quantitative easing QE at that time, and on a big scale. Really, so that the process of money creation by, it turned out, central banks who did it, should be large enough so that the positive effect on money of QE should outweigh the negative effect of the banks reacting to their new capital demands. What happened was in 2009, 10, 11, that bank lending to the private sector actually fell in places like the US, UK, and so on, utterly unlike what had happened in the previous 60 years. And that would have led to a fall in the quantity of money, nothing else to happen. In practice, there was growth of money at very low rates, like in the US, 2, 3, 4% in that period. But 1 year, 2010, quantum actually fell in the US. In the UK, about 5% a year, again, 3, 4, 5% a year kind of thing. These money growth rates were much lower than had been seen in the previous 30, 40 years. And so, although QE was taking place, I said inflation would stay under control. In fact, I said inflation would be very low. People were surprised by that. Always look at what's happened to the quantity of money. That's what matters.
So if I paraphrase again, yes, a lot of money was created then, but a lot of money was also being destroyed then, so the overall quantity didn't increase. Based on your model, which has been correct for the last couple of years with regards to what happened as a result of all the money creation that happened as a result of the response to COVID, you've predicted, I believe, inflation of 5.5% to 7% over the next couple of years.
My latest is that inflation in Britain and Europe will probably be in the 5 to 10% area for the next couple of years. There's a lot of talk of the kind of numbers we're going to get in April and May, when we've got the energy price hike, that being the peak. I wouldn't be sure of that. I don't expect it to get up to 15%, but I find it possible we'll get up to 8, 9, 10% in Britain and Europe. For the US, what I'm saying is a high risk of double-digit inflation. I think that's correct. If you look at the US in the 3 years to the end of 2021, the end of last year, the quantity of money rose by 46%. Now, the trend growth rate of the economy isn't much more than 2%. That's of output. Also, COVID has had some damaging effect on the supply side capacity of the economy. So the trend growth rate must have been lower. How much lower, I don't know, but you're therefore talking about a 46% jump in the quantity of money in that 3-year period against an increase in the productive capacity of the economy to produce output and so on of 3 or 4%. Obviously, there's a huge monetary overhang. And that's why there's a boom in the US, all right? I mean, that's the key to it. That's why the labour market's so active, why house prices are rising so rapidly. It's been We had a 17% rise in US house prices in, I think, the year to July or August last year, and it's still running at around about 12, 13, 14% kind of number. So that obviously it's been a very strong stock market. Retail sales have been soaring. These things are all related to the monetary situation. I don't assume from all that that's where it's going to stay out to 2023 and 2024. And one of the things that we need to be aware of is that booms are followed by busts. And what it looks like is that the Federal Reserve, the Bank of England, the European Central Bank, all these central banks, they realize something's gone wrong with what they've done. So they're now going to take action to reduce inflation. And it's quite possible that we're going to get quite a sharp contraction in money growth, with inflation persisting for a bit in the way that it tends to do, because of all these lags in the system. And then you get a contraction in real money balances, and this then is typically associated with falling asset prices. So one thinks about what happened after the Heath Barbour boom in the early 70s, the Lawson boom in the late 80s. You often get a property bust. So anyway, that's where these cycles work.
Whatever the rate of inflation ends up being, it's clearly going to be far above what the Fed and the Bank of England are targeting. So what do you think they will do about it, and what should they be doing it if those answers are different?
Essentially, the key to stability is low growth of money, quantity of money to achieve monetary stability. That means low inflation. And the key to having a stable economy is stable growth, the quantity of money. So as far as the trend growth rate of output in the UK, Europe isn't much more than 1% a year, the US at only 2% a year. So advocating to have inflation down at, say, about 2%, but money growth should be between, say, 2 and 5% a year. And I would like the central banks to recognize that as a target and to follow it. It's not going to happen. And so I don't know exactly what's going to happen in terms of the next 2 or 3 years. I find it all too plausible that instead of the asset purchases that we've had from March, April 2020 through to the end of 21, we're going to have asset sales. Okay, so that the gilts and so on that the Bank of England holds be sold to the financial institutions. That then means that the financial institutions have less money balances in the aggregate. That then is a negative effect to asset markets. Okay, and the only thing to do is really, I speak from experience, is to follow these figures on a month by month basis, because there's a lot of noise in the system. Exactly how all this pans out, I don't know, but I would be expecting is that money growth in the US, here, Europe, in the next year or two will be much lower than it was. Inflation will be rather high, and we'll be entering a period of contracting real money, problems for asset markets, and so on.
Is it possible or likely to have a soft landing, I suppose, to kind of bring everything back to where it should be without having big declines?
Could we avoid this in 2023? Yes, we could in one way. We could simply tolerate the inflation. Then if we tolerate the inflation running, say, 7, 8%, if we have money growth continuing to chug along at, say, 10, 12, 15%, yeah, it's okay. There's been no recessions. And we have a double-digit inflation again. To get back to 2% inflation within a reasonable time horizon, there's no way out of it. There has to be a recession. I'm sorry. And it sounds so grim. I can't do anything about it. That's just the way the world is.
Why does it matter if we have high levels of inflation, if it ends up resulting in wages going up as well, so everything costs more but everyone's earning more, and it means that you just get to print money when you want to get yourself out of trouble, then why is that a bad thing?
The biggest damage to the economy, I think, comes from trying to take long-term decisions when there's a rapid inflation rate. Because what is the correct rate of interest? Suppose that the inflation rate is 25%. So it's very simple. What you really need is a 28% interest rate. That'd be the same as with 2 or 3% interest rate in a normal world, in a stable price world. No, it isn't. You as a property developer, your first year, you've got to pay interest of 28%. On the end say, well, the 28% is not the right rate of interest, but the right rate of interest is 20%. And somebody else says, no, look, 20% interest means that you're going to lose 5% each year. Long-term investment plans are much more difficult in an inflationary world. And also because there's this uncertainty about where you get more intense bargaining about prices and wages, and then you get tension between unions, labor, and employers. So all these things that we saw in the 1970s and to some extent in the 1980s in Britain and elsewhere, all of these, the problems of long-term investment being discouraged, of social tension, all these things are obviously when you get to hyperinflation, it's much worse than that. And it's kind of the extreme, this is perhaps to put it, 1923, the savings of the German middle class were totally wiped out by the Weimar hyperinflation. That poisoned German politics right through into the 1930s when what was it that happened in Germany? No, we don't want rapid inflation, thank you very much. And we should have stable prices. And can I just show that, just say finally on this front, we did have a period, a great moderation from the early 90s to 2007 in the UK and early 80s to 2007 in the US, similar in much of Europe, when inflation was under control and these were periods of good growth, stable employment, low unemployment. In the long run, there is no trade-off between inflation and unemployment. Societies benefit on both the employment front and the prices front from having low inflation. Even better, full price stability, actually, but there we are. The dream.
As a final question, could this be achieved? Is there any reason that it cannot be, or have people simply chosen not to?
Take Britain. We reduced inflation from over 20% on a volatile rate in the 1970s to 2% and kept it there stable for many years. We did do that. If that can be done, we can reduce it from 2% to, say, 0.5% a year. My preference would, in fact, be for a regime in which the central bank is required to keep the price level, not the inflation rate, the price level at the end of the next decade less than 10% above its current level. In other words, the target kind of 1% a year inflation. But if, somehow you're not going to miss it, then the job of the central bank is to bring it back to a level of the price of prices, so that people start to think about not the inflation rate, but about the level of prices. Then you really are getting back to a price stable world.
And once we've been through what you believe is going to play out, which is sort of the higher inflation followed by the bust on the other side, do you think there's any prospect of policy changing and entering that kind of world?
I was involved in the advocacy of monetary targets as a young man in the 70s and 80s. I remain in much the same place as I was then. I'll continue to advocate the same kind of things. I don't expect to have much success.
I love that, Rob. We've been threatening to do a podcast on inflation for a while, but finding somebody who didn't have the biggest following on YouTube just be quietly in his little corner of the internet being so right is a fantastic find. And this is definitely a subject that we need to come back to and do an episode on ourselves and discuss this more, because inflation is so important. We talk about it on the podcast all the time, but if you don't understand it, you don't understand property investment. It works so in your favour in more than one way. So understanding inflation, how it impacts you, and potentially what's going to happen with it is absolutely huge. So, understandably, I think it's quite right as Hub Extra, we give you his YouTube channel and a little bit more as well. His YouTube channel is called the Institute of International Monetary Research. If you go to the show notes on our website, you will see the link to that. And while you're there, check out another one of our favourite economists, Ray Dalio, and his Principles channel. He is really churning out so much content right now, and his recent video on the changing world order sounds very dramatic, but actually I think you'll find it very useful, is well worth a watch. But the one that kind of got our attention with Ray, and one of his first, if not first, YouTube video, and the one we refer back to all the time, it's an absolute classic, is how the economic machine works. Again, These links will be in the show notes, so head over to propertyhub.net if you want to see them. And of course, while you're there, show Tim some support. Make sure you subscribe. You can subscribe to Ray as well. He's got lots of followers already, but it's really interesting content to make sure you keep seeing that stuff. And of course, why wouldn't you, while there, subscribe to the Property Hub channel as well. That's Property Hub UK.
Well, that is us done for another week. What a great episode. And let us know what you think. We'd love to hear your opinion on this episode and anything that's been covered. So you can get in touch with us on all the socials. Property Hub UK is our handle. And of course, we mentioned Portfolio back at the top of the show. You can learn more about that at portfolio.co.uk. We have got another great episode lined up for you next week. So please do join us for that one. And we'll look forward to seeing you then. Bye-bye.
Bye-bye.